Most people lose money during a recession, not because the economy is crashing, but because they put their money in the wrong stocks. The truth is, recessions create some of the biggest opportunities for stock investors, if you know where to look. Forget about trying to time the market perfectly or listening to mainstream advice that tells you to avoid stocks altogether. That approach keeps people stuck. Instead, I'm going to show you where the wealthy put their stock investments during an economic downturn, so you can come out ahead while everyone else is panicking. I get it. A few years ago, I was just like most people, investing in whatever was trending, hoping for big returns. Then the market crashed, and I watched my portfolio lose thousands overnight. It felt like I was powerless, just another victim of the system. But then I started studying what successful investors were doing. They weren't panicking. They weren't selling off everything in fear. Instead, they were strategically moving their money, buying quality stocks at a discount, securing cash-flowing dividend investments, and setting themselves up to profit when the economy recovered. That's when it hit me. Recessions aren't a time to fear, they're a time to buy. And once I changed my approach, everything shifted. So where should you put your money in a downturn? Let's start with one of the most powerful asset classes, dividend stocks. While everyone is focused on stock prices dropping, smart investors are looking at cash flow. Dividend-paying stocks give you regular income, even in a bear market. Companies like Johnson & Johnson, J&J, Procter & Gamble, PG, and Coca-Cola, KO, have a history of paying dividends for decades through recessions, market crashes, and economic uncertainty. The key here is consistency. You don't just want a company that pays dividends. You want a company that increases its dividend payout year after year, no matter what the market is doing. And here's the part most people get wrong. They assume they need to invest in high-growth tech stocks to make money. But in a recession, it's the stable, cash-generating companies that dominate. Next, let's talk about real estate through stocks. Instead of buying physical properties, smart investors look at real estate investment trusts, REITs. REITs allow you to invest in income-producing real estate without the hassle of property management. During a downturn, certain REITs like Public Storage, PSA, or Realty Income O, continue paying dividends and generating revenue. Why? Because even in recessions, people need storage, retail space, and rental properties. The mistake most people make? They think real estate crashes mean real estate stocks are a bad investment. But if you focus on REITs with strong cash flow and defensive property portfolios, you'll have an asset that continues paying you month after month, regardless of what the economy is doing. Some of the best real estate investors in the world build their portfolios during downturns, and REITs allow everyday investors to do the same with much lower capital requirements. Speaking of defensive investments, let's talk about one of the safest stock plays during a crash. Utility and consumer staple stocks. These companies provide essential services that people rely on, no matter what's happening in the economy. Think about companies like NextEra Energy, NEE, Duke Energy, DUK, and PepsiCo, PEP. Electricity, water, and food aren't optional, which is why these stocks hold up when everything else is volatile. The key is to focus on stocks that not only provide essential services, but also have pricing power, meaning they can pass costs on to consumers without losing demand. That's how you create a recession-resistant stock portfolio. Another stock sector the wealthy turn to during downturns? Precious metals, through mining stocks. Throughout history, gold has been a hedge against inflation, market crashes, and economic instability. But instead of just buying gold, smart investors look at companies that mine it. Stocks like Barrick Gold, and Newmont Corporation, NEM, give you exposure to gold's price movements while also generating cash flow. During the 2008 financial crisis, gold surged while stocks tanked, and mining stocks followed suit. The key here is to view gold stocks as a way to hedge against market uncertainty, not as a get-rich-quick play. They won't double overnight, but they will help preserve your wealth when everything else is crashing. Now, let's talk about one of the most overlooked recession-proof stock investments, cash-heavy companies. That's right. Sometimes, the best move isn't just sitting on cash yourself, but investing in companies that have massive cash reserves. Why? Because cash gives these companies flexibility. While other businesses are struggling to survive, cash-rich companies can buy out competitors, expand operations, or reinvest in their own growth. Apple, AAPL, Alphabet, Google, and Berkshire Hathaway, BRKB, are prime examples. These companies have billions in cash, allowing them to weather downturns better than debt-heavy competitors. The mistake most investors make? They ignore balance sheets. But in a recession, a strong cash position can make the difference between a stock that survives and one that thrives. But what about alternative stock investments? One area that continues to grow, even in downturns, is recession-resistant businesses. Think about companies in the healthcare sector like United Health Group, UNH, or CVS Health, CVS. No matter what happens in the economy, people still need medical care and prescriptions. During a recession, healthcare stocks often outperform because demand remains stable. Investing in stocks within these essential industries can provide stability and even growth when other sectors are struggling. So, what's the takeaway? Recessions aren't something to fear. They're opportunities in disguise. The key is knowing which stocks to buy. Dividend stocks provide consistent income. REITs give you exposure to real estate without the headaches of ownership. Utility and consumer staple stocks offer stability. Gold mining stocks act as a hedge against uncertainty. Cash-heavy companies have the resources to survive and thrive. And healthcare stocks remain strong when everything else is shaky. The biggest mistake you can make during a downturn is to panic and sell. The people who come out ahead aren't the ones who retreat. They're the ones who strategically invest in the right stocks. If you found this helpful, subscribe for more No BS finance videos. Smash the like button if this helped you out, and drop a comment if you have any questions. Now that you know where to put your money in a crash, the next step is learning how to spot the best stock opportunities before everyone else does. So stay tuned for the next video, where I'll break down how to find high-value stocks at recession-level prices. And remember, wealth isn't built in times of prosperity. It's built in times of uncertainty. Those who take action today will be the ones who reap the rewards tomorrow. The choice is yours. Sit on the sidelines or take control of your financial future.